Let's be real, the Polkadot chart looks absolutely terrifying right now. We are coming off a hard dump that flushed the price down to $1.50, and sentiment is completely in the gutter. Most people are calling for zero. But while the price is bleeding, something massive just shifted under the hood that nobody is talking about. We finally have native smart contracts enabled on Polkadot. Not parachains, not complex bridges, native, direct smart contracts. This removes the single biggest friction point for developers. I know many of you are staring at your portfolios in the red. I know my last stop-loss level technically triggered on a closing basis. But I'm going to show you exactly why I did not close my trade, why the falling wedge structure is saving us for now, and the specific do-or-die level at $1.37 that will decide the fate of this entire cycle. We need to address the elephant in the room immediately. The last few weeks have been brutal. We have seen a relentless bleed down to these lows around $1.50. The market has been punishing harder everything that isn't Bitcoin or a high-flying meme coin. If you are feeling the pain, you are not alone. This is what capitulation feels like. We are still trading below every single major exponential moving average. The 10, the 21, and the 200 simple moving average. It's all overhead resistance now. The trend is objectively down. There is no sugarcoating that. But as an analyst, my job isn't to trade my feelings. It's to trade the structure. And despite this hard dump, the macro structure has not broken yet. We are compressing into the very tip of a massive falling wedge that has been forming since September 2025. Volatility is dying out. When volatility dies, a violent move is born. The only question is, do we finally get the reversal, or is this the final flush? While price is dumping, the fundamental thesis just got its most important update in years. And no, I'm not talking about the supply cap. We covered that weeks ago, that's old news. I'm talking about the confirmation we just saw it here. Native smart contracts are enabled on Polkadot. Why does this matter? For years, the biggest criticism of DOT was complexity. If a developer wanted to build, they had to win a parachain auction, lock up millions in capital, and build a whole custom chain. It was too hard. It pushed builders to Solana or Base. With native smart contracts, that barrier is gone. Developers can now deploy decentralized apps directly on the Layer 1. Actually, Polkadot is a Layer 0, but for your better understanding, it's kind of just like they do on Ethereum. This simplifies the entire onboarding process. When you combine this with the elastic scaling update, which has confirmed block times dropping from 6 seconds to 2 seconds, you effectively have a new blockchain. It's faster, it's more accessible, and it's finally user-friendly. We also have to look at the on-chain security. We can see that over 50% of the total supply is staked. That's over 870 million DOT locked out of circulation. Even during this dump, that number has remained robust. The holders are not leaving. It's the speculators who are fleeing. But here's the catch. Fundamentals do not stop price dumps in the short term. Liquidity does. And right now, liquidity is thin. So while the tech is bullish, the market doesn't care until the chart confirms it. Let's zoom in on the weekly chart. This is where the battle is being fought. We are stuck inside this falling wedge pattern defined by the white dotted lines. We have been trapped here for months. Now, I want to address the Fibonacci levels because I have had to adjust them based on this new low. I am now anchoring the retracement from the $3 low in June 2025 up to the $4.88 high in September. This gives us a critical line in the sand at the 2618 Fibonacci extension level, which sits exactly at $1.37. This is the most important number on the chart. As long as we hold 137, the bullish divergent structure is valid. If we lose 137, we enter price discovery to the downside, targeting 85 cents. Currently, we are testing the support of the wedge. We have wicked below it multiple times, but we have not seen a catastrophic candle body close below the entire structure. Look at the Heikinashi RSI at the bottom of your screen. It's back in extreme oversold territory. The last 2 times we were this oversold, we saw bounces. However, notice the trend lines on the RSI itself. It's also in a downtrend. We need to see the RSI break that orange descending line to confirm any momentum shift. Right now, it is pointing down, signaling that the bears are still in control.
This brings me to my personal strategy, and I want to be very clear about why I did what I did this week. Many of you here, and the ones in my Telegram community, know that my previous stop loss was set around $1.65. On Sunday, the weekly candle technically closed below that level. However, I did not close my trade. Why? Because of market structure. Yes, the price dipped below the horizontal level, but it did not lose the falling wedge pattern. In technical analysis, diagonal structures often carry more weight during consolidation phases than static horizontal levels. I viewed that dip as a liquidity grab, a fake out to shake out weak hands before the wedge resolves. So, here's my stance. I'm holding my swing trade and my long-term position, but I'm not in denial. My new invalidation is hard and fast. If we see a weekly close below the wedge support line, effectively losing that $1.37 fib level, I'm out of my swing trade, keeping only my long-term bag. That would confirm the wedge has failed and the pattern is broken. But if this wedge holds, the upside is significant. If we break out to the upside, we immediately face the 1618 Fibonacci level at $2.23. This is our first major take-profit zone. It was a support that turned into resistance. Beyond that, we have to clear the two orange descending trend lines. The first one comes from the December 2024 top at $11. The second one is the multi-year resistance from the all-time high at $55. So, what's the game plan for the next few weeks? We are in survival mode. Scenario A, the wedge breakout. If Bitcoin stabilizes and DOT reclaims $1.80, we are likely breaking the wedge to the upside. In this case, I'll look to add to my position on the retest. My targets are, first, $2.20, second, $3.60, third, $4.80. The moonshot targets of $7.50 and $11 are off the table until we prove we can reverse the trend. Let's be realistic. Scenario B, the breakdown. If we lose $1.37, the short-term thesis is dead. In this scenario, I'll close the swing trade immediately to stop the bleeding. For my long-term bag, which I never sell, I'll open a short hedge. I will short DOT targeting 85 cents and 65 cents. This protects the dollar value of my portfolio while we wait for the bottom. We also have to watch the yield environment. With the risk-free rate on-chain at 12% and some pools on hydration paying 15%, you should be compounding every single day. In a bear trend, yield is your only defense. If you are just holding in a wallet doing nothing, you are bleeding value. The news about native smart contracts is a massive fundamental unlock that makes Polkadot competitive again. The tech is ready. The 2-second block times are real, but the market is ugly. We are in a hard dump, and the price is testing the absolute limits of this falling wedge. I chose to stay in the trade because the structure is still intact, but I'm watching $1.37 like a hawk. This is not the time to be a blind bull. It's the time to be a disciplined risk manager. If you value this kind of rational, level-headed analysis while everyone else is panicking, make sure to hit that like button and subscribe. It supports the channel and guarantees you won't miss the next update when this structure finally breaks. If you want to know the exact moment I close this trade, or if I add more on a breakout, join my Telegram group. I update you guys there in real time, faster than I can make these videos. The link is in the pinned comment. Stay safe, protect your capital not leveraging in this market. Remember, my videos are never financial advice. Thanks so much for watching. I'll see you soon in the next one.